Okay, good morning, everybody. Hope you are having a great Tuesday morning. My name is Tara. I'm here with Bill Witt, and we are doing the next segment of our live series for SRC University, Pay Less Tax. Thanks so much for joining us. And like always, we're just to kind of explain what SRC University is. It's for retirement education. We do 30-minute sessions and make them available to your schedule, whether you can be here live or you want to listen to them later. They're always available on our website. A lot of the topics that we cover are in our book, and you're always welcome to download a free copy from our website, srctexas.com, as well as you can purchase a book and we will mail you one for free. You just have to pay the $5 shipping. And our ultimate goal is to help people create a safe, secure retirement. And as always, our school has no final exam. Okay, so if you missed any of our summer and fall webinar series, these are some of the topics we already covered. They are at srctexas.com under webinars. You join our SRC University, you'll have access to all of these for free. And today we're talking about pay less tax, taking advantage of the tax tables. And then next week we'll be talking about tapping into home equity to support your lifestyle. All right, so at Senior Resource Center, we help in 4 comprehensive ways. We do comprehensive retirement planning, looking 20 and 30 years in advance, making sure that you don't outlive your money. We also do tax planning like we're going to talk about today. We're not CPAs, so we don't do tax prep. We also do a lot of long-term care planning, helping people qualify for federal and state programs like VA and Medicaid. And then we do estate planning, making sure that your wishes are met, whether you're alive or when you pass. All right, so with that, I'm going to pass it over to Bill.
Hey, thanks, Tara. Welcome, everybody. Today's topic is a very important one, and I think you'll see in a few minutes that taxes are a major drain on our wealth, on our income and on our wealth. And we're going to talk about different strategies to deal with this, to try to reduce it. Very simply, in our practice, we try to maximize what is coming into our clients in the form of income so that you have money to create lifestyle in retirement. Usually after we stop working, our employment income stops, and we want to replace that with other income to support our lifestyle. But the other side of the equation is the outflow. And, we do webinars on long-term care, how to reduce paying for it, on how to pay less for Medicare and health expenses in retirement. And so taxes, a lot of times people think, well, taxes are just part of life. I've got to pay my taxes. But what you're going to see in this webinar is that there's a number of important strategies that are legal that help us reduce how much tax we pay. And why is this a problem? Well, the United States has the most complicated tax system in the world. And the tax rules are complex, and they're constantly changing. So having a plan to pay less tax is important to having a safe, secure retirement. There may be one bit of good tax news. I'm not making a political statement, but the election of Donald Trump as president, a number of years ago, he enacted tax reductions. He passed a bill that reduced our taxes, and those were expected to expire at the end of 2025. And I think probably with a Republican Congress and a Republican president, we'll probably see those tax cuts extended. That's my hope, because like you, I like paying as less tax as possible. So how broad is this problem? We tend to think, well, I pay a couple of kinds of tax. I pay income tax, but we're also taxed on our Social Security income. And as we're working, we're having to contribute to Social Security. There's Medicare taxes. We're going to talk about a Medicare surcharge, the IRMA taxes that we pay. But beyond that, there's a whole variety of other taxes that are kind of built into our system. And all of these drain the amount of money that we have. And, if we look at this, income taxes range anywhere from 10% up to 37%. Our Social Security tax, the first $176,000 we earn in 2025, will be subject to that 12.4% Social Security tax. What about Medicare? Well, there's no income limit on that. It's 2.9%. We're going to talk about Medicare IRMA surcharges that affect different parts of Medicare, cause us to pay higher premiums for our Medicare coverages. Property taxes. The average is 1.6% in Texas, and that happens to be the seventh highest, where Texas is the seventh highest property tax state in terms of taxes. Sales tax in Texas, it ranges from 6.25% to 8.25% on everything we purchase. There are capital gains taxes that can be anywhere they can represent normal income taxes on capital gains, or they can be taxed at 0, 15%, or 20%. There's taxes on vehicles. If you purchase or repurchase a vehicle, you're paying a 6.25% tax. There's taxes on our gasoline. In Texas, the average is 38.4 cents, which is 20 cents levied by the state, and another 18.4 cents levied by the federal government. If you buy certain items, alcohol, cigarettes, they also have taxes, excise tax, just to have to be able to consume those products. There are privilege taxes like registering your vehicle. I have 3 vehicles. Every time I register them, I go, gosh, this is costing more and more. Many businesses in Texas pay a franchise tax. It's only 0.75%, but for those businesses subject to it, it's something they have to pay. And then lastly, we have gift and estate taxes. What this shows is that we're being taxed on so many different fronts that it's important to understand the scope of this problem and then to figure out strategies where we can use the law to our own defense. So understanding all the taxes you're paying, that's the first step. Making informed choices to reduce your tax obligation, that's very important, because every dollar we get to keep is a dollar you can either save or spend on something else. And so since this is going to be a lifetime adventure for most of us, let's look into different strategies. Today, I want to look at just a number of the strategies. This is just a piece of what we do in our practice, but we're going to talk about strategies to pay less income tax. We're going to talk about strategies to reduce IRMA surcharges. We'll see that higher income people pay more for their Medicare than other people. We'll talk about ways to reduce tax on retirement accounts. If you have an IRA, a 401k, you're going to be paying taxes on those withdrawals. We'll talk about less capital gains tax, where that applies. We'll talk about ways to take advantage of the property tax rules in Texas. And then at the end, we'll open it up for your tax questions. So let's start out by talking about income tax. If you haven't studied this, we have what's called a progressive tax system in the United States. And this shows the tax brackets for 2025. So if you're single in 2025 and you earn $11,925 of taxable income, it would be taxed at a 10% rate. Above that, you move into the 12% bracket. So from income from $11,925 up to $48,475, you're paying a 12% tax. If you go above $48,475, you're in the 22% tax bracket. And as you can see, this steps up 24, 32, 35. And for the high income individuals, they actually get up into the 37% bracket. Well, so how can we take advantage of this? Well, first, one of the things that Trump did pass back a number of years ago when he was in the presidency was he raised the standard deductions that we claim. Now, you can either claim a standard deduction, which reduces your amount of taxable income. For single people next year, it'll be $15,000. If you're over 65, you get an extra $2,000 bump. For married couples, the standard deduction is $30,000. And if you're over 65, if both spouses are over 65, you get an additional $3,200. So how does this work? How do we take advantage of the tax tables? Well, I want to use the 12% bracket as an example. You'll see down below, I show the standard deductions, and then to that, I add the taxable, the top of the 12% bracket. For single people, that's adding the 48,475. For married couples, it's 96,950. So what is this telling us? It says that if a single person earns 65,475 or less, when they claim their standard deduction, assuming they're over 65, all of their income is being taxed either in the 10 or the 12% bracket. What if you're married? Well, if your gross income is 130,150, all of your income, once again, is being taxed either in the 10 or the 12% bracket. Now, those are the low brackets. So that kind of begs a question. Everybody's in one of the brackets. We're all in one. And the question is there ceiling room? In other words, let's say I'm married, which I am, and our combined income, our gross income is, let's say, $100,000 a year. Well, I have a $30,000 buffer there. I have $30,000 of wiggle room still in the 12% bracket. And that's a very low tax bracket. So let's talk about how we can take advantage of the tax tables. So that begs the simple question, are you above or below your optimal gross income? Let's say that 12% ceiling is my optimal gross income. Well, if I'm below it, let's say once again, my wife and I earn $100,000 and we're in the 12, so we're in that 12% bracket, but we have $30,000 of wiggle room. Now, 12% is a very low tax bracket. Most economists think in the future tax rates are going to go up to support the national debt. So how might we take advantage of that? Well, one thing we can do is we might start doing some gradual Roth conversions. And within our practice, we do long-term retirement planning where we build models that go out 10, 20, 30 years. Once we've built the model, we can then make adjustments to it. We can investigate things like, what if I'm doing gradual Roth conversions? Let's say my wife and I, our combined income is $100,000. We have $30,000 of wiggle room still in that very low 12% bracket. How do we take advantage of that? Well, if I've got an IRA with $100,000 in it, I could gradually Roth convert it by taking $30,000 out of my IRA for 3 or 4 years and gradually convert it at that low 12% tax bracket. And the models we build help our clients look into this and decide, hey, is there some financial gain by doing Roth conversions? And usually the models show that people have much better futures. Not only do they end up with more money in the future, but the money they pass to their children is tax-free, because that's the primary difference. Traditional IRA is always taxable. A Roth IRA, whatever it grows into, your kids can inherit and spend, and they never pay a dime of tax on that. So if you're below an optimal tax ceiling, one of the things we should investigate is gradual Roth conversions. Well, what if you're above an optimal gross income? Going back to a married couple, remember the total threshold is 130. Let's say my wife and I are at 140, which means 10,000 of our income is being taxed at that higher tax rate, the 22% rate. Well, where is there an opportunity here? What's the source of that extra income? Now, if it's coming from Social Security or a pension, we don't have any flexibility on that. But many people have a brokerage account. Some people have CDs paying 4 or 5%. And that interest on the CDs is forcing them into a higher tax bracket. So what is the opportunity? We could investigate tax-deferred options. There are products like annuities that grow tax-deferred. What does that mean? It means like an IRA, when I'm working, I contribute to my IRA, don't pay any taxes until I start taking money out of my IRA. Well, with a CD, if I have money in a CD, I get a 1099 every year, and the government wants a piece of what my CD earned. Just by moving those funds from a CD into a tax-deferred annuity, you still get the growth. There's annuities that are paying 4 and 5% on fixed accounts, but you don't pay tax on an annual basis. You can defer the taxes, allow the dollars that are in there to compound and grow. So instead of taking a chunk out every year to pay Uncle Sam, I let all the money in there, And when we run models, it shows that compounding allows the funds to grow faster because the money stays in there. And next year, when you still earn 4 or 5%, you're earning it on a bigger base. Best of all, you get to decide when you want to pay the taxes. You only pay taxes when you take money out. So if you don't need to take the money out, rather than let it sit in a CD that rolls over annually, where I have to give a share to Uncle Sam, why not put it in something that grows tax deferred, and you get to decide when the taxes are paid? So that's just a snippet on income tax planning. If you have questions on that, we'd love to help you. Just schedule an appointment, come in and see us. Our consultations are always free. Happy to answer your tax questions. So the second topic is less Medicare IRMAA surcharges. Oh gosh, that's a big term. IRMAA, what is that? Well, it's the income-related monthly adjustment amount. A what? Monthly adjustment amount. And what is it? Well, it causes people in higher income brackets to pay more for parts of Medicare coverage. Which parts are covered? Parts B, C, and D. If you're on Medicare and you're paying a Medicare B, C, or D premium, and your income is above a certain level, you're paying a higher amount. Now, if you look at a chart, we've done a number of webinars on Medicare options, planning, and you can go back and listen to those at your leisure. But this is a simple chart that we use in describing Medicare options in our practice. And you'll see on the left side, we have original Medicare. And you, at age 65 or later, I sign up for parts A and B from the government. Those are the foundation blocks. Part A is your hospital coverage. Part B is your doctor and lab. And you can see that parts A and B have deductibles and copays. So above that, you see what's called a Medicare supplement or a Medigap policy. And there are 10 standard plans, and they cover most of or all of what parts A and B don't cover. And then above that, we have prescription drug coverage. That's a help paying for your drugs. And that box and the box on the right side, the Advantage plans, they were created back in 2006. Well, you notice I have 3 boxes highlighted. The Part B, which for most people, the standard premium is $185. I also have the prescription drug box highlighted. That's Part D. The premiums there are affected by IRMAA, and the Advantage plans on the far right side are also income related. So who's affected by IRMAA? Well, let's talk about this. If I'm an individual and my modified adjusted gross income is 106 or less, or if I'm a married couple and our combined income is 212 or less, we pay the standard Medicare premium. Last year it was $174.70. One number we know for sure for next year is the Medicare base premium, which is going to go up to $185. So if you're in a low income bracket, you'll be paying $185 for your Medicare B premium next year. But what if you're a couple of dollars above the income levels that I show in that first line, above 106 or above 212? If your income is 106 and $10, you're going to pay $244. Now, once again, they haven't released the 2025 numbers, so I have to show in here the brackets for this current year. In 2024, if you were $1 above the threshold, your monthly premiums went from $185 to $244. This is not a progressive increase, meaning if you're $10 over the 106 threshold, those $10 are subject to the increase. No, if you're $10 above the 106 threshold, you pay the $244, the much higher premium every month, all year. If you're above the 133 threshold, if you're single, you pay $349. So getting below these thresholds can be very saving in terms of taxes. They don't call this a tax, but it is. It's a surcharge or an additional premium you have to pay. And so we work with our clients on doing income planning and go, hey, looks like you're married and your combined modified adjusted gross income is going to come in at 267. Hey, whoa, if we can get it down just $1,000, you'll go from $349 a month for each of you with spouses down to $244. Hey, that's nearly $100 a month per person. That's a lot of money. So it's important to understand which income bracket you're in and then investigate options. Well, what's an example? Once again, going back to my CD example, let's say the CDs are what's pushing me just above the 266 threshold as a married couple. Well, I move those CDs over to a tax deferred annuity, and guess what? I just saved $100, $110 for each one of us. That's $220 a month. That's a few trips to McDonald's. So we want to be sensitive to what the Medicare B, what these thresholds are, and understand where we're at and take advantage of what the government's offering. If they tell us, hey, by dropping from 213 down to 211, I drop down from 244 to 185 for each one of a married couple, that's an important step. What about Part D and Advantage plans? Well, they too face the surcharge. And here's the surcharge for 2025. Once again, same income thresholds. If you're below the 106 as a single person or 212 if you're a married couple, there is no surcharge or add-on to your Part D premium. By the way, we did a number of webinars on Medicare. You ought to go back and listen to those because there's major changes coming to Medicare in 2025. And you want to make sure you're on the most cost-effective plan for next year. And so I highly recommend going back and listening to that. But once again, we look at the increased surcharge that's tagged on. These are not as significant as they were for Part B, but it's still money in your pocket if you can drop below one of these thresholds. So here's something else to know. The income levels are not based on your income in 2025. They're based on your income in 2023. Really? Yeah, the government goes back. They don't use current year income to determine the surcharge. In fact, let me step back and just talk about this. Once again, that 106 or the 212, that's your income that you earned back in 2023. Well, for many of us, maybe our income has dropped. Maybe we retired. Maybe we got divorced. So things change. And so you can report a life-changing event to Social Security. We use Form SSA 44. So let's say I retired at the end of 2022. My income dropped. Well, I want to report that so that they're not, or let's say it dropped at the end of 2023. I want to be able to report that, hey, my income has dropped. I'm retired now because of retirement, and I want to report a lower income in 2023 or 24 so that I get a corrected IRMA surcharge. And maybe I don't pay any surcharge if I've now lost income. You can also report incorrect tax information. Sometimes Social Security gets the wrong data from the IRS. And so there's a form SSA 561-U2. Once again, this allows us to report corrected tax information. You know, many people file their taxes and then their CPA finds something they missed, so they refile. Well, we want to make sure Social Security is aware of the actual lower income if that's appropriate. What about tax on retirement accounts? I touched on this earlier. You know, for most of us, retirement accounts and your home are your primary assets as we move into retirement. And retirement accounts impact what you and your heirs will be paying in taxes in the future. So how does this work? Well, for most of us, when we turn 73, the required minimum distributions kick in. For many people, they go, hey, I don't need the money in my IRA or my 401k. I'm just going to let it sit there and compound and grow. And that's great up till the year we turn 73. At 73, the government says, Bill, we've been giving you deferrals all this time. Now it's time to start taking money out. Well, how does it work? There's a chart. If you get our book, there's a chart in there in the chapter on retirement accounts. And it shows that based on age 73, there's a divisor. And when I divide that into my IRA balance, on January 1 of the year I turned 73, it says, Bill, you got to take out about 3.8%. The percentage we take out or of required minimum distributions goes up every year as we age. So that starting percentage may look low, but it keeps going up, and it actually goes up to 50% if you live long enough. Most of us may not, but we're forced to take more and more money out. The required minimum distributions impact our future income tax bracket. They can force us into a higher tax bracket. Then they may cause you to be subject to IRMA surcharges. So, what are some of the strategies we can take advantage of to pay less tax on our retirement accounts? We've already touched on one. One was gradual Roth conversions. They can be done before and after age 73. So if your income is low now or lower now, you want to take advantage of converting IRA and 401k dollars over to Roth dollars, because there are no required minimum distributions on Roth, and the money that comes out is always tax-free. Now, a second option that a number of our clients have taken advantage of is what's called a qualified charitable distribution, or QCD. Let's say your RMDs are causing you to be in a higher tax bracket. So you're not only paying more income tax, but you're getting hit with those IRMA surcharges. Well, a number of our clients have a charitable bent. They go, Bill, I don't need the money coming out of my required minimum distribution, and I really would like to contribute to a charitable organization. Well, under federal tax laws right now, people can contribute up to in 2025, up to $110,000 of money coming out of an IRA or a 401k. That charitable distribution qualifies as the RMD, so you're satisfying your RMD, and at the same time, it reduces my taxable income. So if you're one of those fortunate people that have a substantial IRA or 401k, don't need the money coming out of the qualified account as an RMD, you can donate it directly to a charitable organization. That gives you good feelings because you're helping the needy, and at the same time, you're reducing your tax obligation, both for income taxes and for IRMA payments. So it's kind of a win-win. And the third one is something we've covered before when we talk about strategies to use retirement accounts in retirement, how to support your lifestyle. And I call this strategy doing smarter RMDs. Let's take a close look at this. Most of us have IRAs or 401ks as we come into retirement. And so I show the same number of dollars on both sides of the page. The only difference is on the right side, I've divided the bucket in two. I show it as a 50-50 split. There's no magic to that. Could be 60-40, 70-30. That's up to you. So here we've divided up on the right side the IRA funds, in this case, qualified money. And I've chosen to put a portion of my money into a product, into a tax-deferred annuity. Once again, these are all IRA dollars. They're all taxable. So everything is the same. So what happens when we turn 73? Well, first, we have to start doing some annual dipping. And that's what most people do. They turn 73, they go to the chart in the book that we offer to people. They look up, I'm 73, the divisor is 26.5. I had 100,000 in my account. I divide that by 26.5. I have to take $3,800 out of my IRA. And every year I go back, get the chart out, do the math, and take more and more and more money out. Well, what's happening on the right side? Well, with that IRA annuity, there's a feature on it that's kind of neat. It's called a lifetime income rider. Lifetime income. So what is that? Well, I'm going to turn it on when I turn 73, and it's going to start spitting out some income. And the income it's spitting out or paying out satisfies the RMD. So once again, both sides, I've got to take the $3,800 out if I had 100,000 in my IRA, and I'm satisfying my RMD on both sides. Well, let's fast forward. I mentioned over time the RMD percentages go up. So what we usually see is the IRA value goes down. Maybe there's a market correction. Maybe you're paying some fees on your brokerage account where it's an IRA. And over time, the annual dipping causes the account value to drop. Well, the same thing's true on the right side. That IRA annuity is satisfying the income payout. Some of the annuities that we know of have increasing income streams over time based on market performance. So once again, we're satisfying the RMD and the account value on that annuity is going down. Well, what happens if we fast forward 10, 12 years from age 73? On the left side, I've got my IRA going down in value. The annual dipping keeps going up. On the right side, we actually drained the annuity account. By 12 years, 13 years out, they've paid out everything we put in, plus whatever it's earned over that 12 or 13 year period. But did I mention the income is lifetime, which means just because I've drained the account doesn't mean it's going to stop. It's kind of like in fact, it's just like Social Security. If you draw Social Security for 10 or 11 years, you've been paid out everything you paid in and your employer paid in, but the checks don't stop. They keep coming. And, as we did an earlier webinar on Social Security, since it's indexed for inflation, the payments go up. That's kind of sweet. Well, an IRA annuity operates under the same premise. Payments can go up if markets are up in the future. And at some point, I drain the account, but the payments keep coming. I call this longevity insurance. It's money you can't outlive. But there's something else that can be accomplished. So far, we've paid taxes on all the annual dipping on the left side and all of the distributions on the right side. All of those dollars are taxable. But what can we do when the IRA annuity bucket is almost empty? We go back to the company that set it up and we say, hey, I want to convert my IRA to a Roth. What? I want to convert my IRA annuity to a Roth IRA annuity. Now, since there's very little money left in the bucket, that's pretty much a tax-free exchange. So we don't pay any taxes on doing that. But remember, Roths, anything that comes out of a Roth is what? Tax-free. So now we've converted our IRA to a Roth, and that tax-free lifetime income keeps coming. That's like giving yourself a raise. You've been taking out RMDs every year or IRA annuity income every year, and you've been paying taxes on it. Well, magically, 12, 13, 14 years into this process, boom, now suddenly we're not paying tax. It's tax-free income. It's like giving yourself a raise when you're 80 years old. I'd like to have more income when I'm 80. So this is a strategy to do it. If you want to know more about how to do this, we show our clients how to do this every day. Here's an example. I said that converting IRAs to Roths can provide a better future financial status for people. So here's an example. Lucy and Bill, both 68. Their monthly budget in retirement, we estimated, this is a real couple, at $6,000 a month. And we build into our model that there's going to be 2.5% annual inflation. Now, at 68, Lucy can tap in and tap Social Security, and she would draw $1,856. If Bill waits till age 70, we did a whole webinar on maximizing Social Security benefits. You can go back and listen to it. But at age 70, Bill's going to start drawing $3,564. He's going to maximize his lifetime payout. And by the way, if Bill dies, we assume Lucy will outlive Bill, then Lucy's going to step up to that higher Social Security benefit. In savings, the couple has about $725,000. $675 of that's in Bill's 401k, and we estimate it's going to grow at 5%. We also did a longevity analysis. We assume Bill will die at 83, but Lucy's from a long-lived family and could well live to age 100. So that was scenario one. What is scenario two? Well, we sat with Bill and Lucy and said, hey, what if we convert $275,000 of the 401k over to a tax-deferred annuity? And at age 70, we're going to turn on the income rider, and they'll start drawing $1,107 monthly income. That income can go up if the stock market's up in the future. So how do these two models compare with one another? Well, this is the beauty of having powerful software. We can model based on income, expenses, inflation projections, growth on assets. We can build 20 and 30-year models that tell our clients where they'll be. Now, on the top, I have Bill retiring at age 70, and you can see that he's passed away at age 83, But this shows assets running out to age 100 for Lucy. And our model shows that she still has solvency. She's got 345,000 at age 100. That's not bad. We always want to have a positive number in the future. But drop down to the second scenario. Remember the one where we used part of the 401k to create additional guaranteed lifetime income. We just boosted the age 100 payout of assets, retirement funds, from 345 up to 587. That's a $241,000 increase. And oh, by the way, a bunch of that 587 is Roth money. Remember, we're generating Roth income. So money's coming out tax free. Well, here's the beauty to this thing. We're not only giving Lucy more income in retirement, and we're not only leaving her with more liquidity, but we're going to be passing more assets on to the next generation, and more of that is going to be tax-free money. If you want to know more about how to do this, give us a call. We put these plans together every day. I mentioned that taxes on retirement accounts affect both the original owner and beneficiaries. One of the things that came into being with the Secure Act that reduced our tax tables under President Trump, they eliminated something that was very nice in the past for beneficiaries. It was called lifetime stretch. So how did that work? Well, if I have an IRA and I die, I pass it to my son, Jesse. Well, he has the choice of withdrawing the funds and paying tax on it, or letting the funds sit in the account and grow tax deferred. He does have to take some required minimum distributions, but because he's much younger, his RMDs are very small. So usually the money has the opportunity to compound and grow. And anything not withdrawn does continue to compound and grow. Well, what did this Secure Act do? Well, it changed the rules for beneficiaries. Now, all IRA 401k funds have to be paid out in a 10-year period after the original owner's death. Well, what's the significance to that? What if Jesse, my son, is in his peak earning years and he's forced to take required minimum distributions and then eventually take all the money out that he inherited within 10 years? That's more than likely going to push him into a higher tax bracket and mean that only a portion of what I'm leaving as an inheritance is going to be really paid to him, because Uncle Sam is going to get a bigger and bigger chunk of my money. Well, what's an option on this? One of the wealth options we talk to our clients about is using IRA dollars while you're alive to fund something that is tax-free in retirement. Like what? Like life insurance. You can use some of the payments coming out of an IRA to fund a life insurance policy. Over time, that policy is going to probably build cash, but more importantly, there's a death benefit. And the death benefit that my son would receive under life insurance is not only tax-free, but there's no restrictions on when he takes the money out. If he needs it, he takes it out and uses it. If he doesn't, once again, he can invest it, let it compound and grow. So we show our clients how to use life insurance proceeds as a way to provide tax-free money to heirs in the future. If you have questions on this, give us a call. Now, another way we pay taxes in our society is capital gains tax. What is that? Well, certain types of assets are treated more favorably. On income, you pay tax based on the income tax tables. But what's a capital gains tax? Well, that's where I bought something and I hold it for a period of time. Let's say I buy 100 shares of IBM stock, and the IBM stock is worth $50 when I buy it, and I sell it within a year. Well, if I sell it within a year, I'm going to, and it's gone up in value, I pay normal income tax. There is on short-term capital gains, that's treated just like income tax in whatever tax bracket I'm in. But what if I've held those IBM shares for more than a year, and let's say they've appreciated in value? I'm either going to pay 0% tax on the gain, 15%, or as much as 20%. But many people are in the 32, 35, 37% tax bracket. For them, 15 or 20% looks pretty nice. And so you want to look at the assets you're holding and figure out where capital gains comes into play on this. Another aspect of assets, some of the assets we own, is they get what's known as a step up in basis at death. What do I mean by that? Well, once again, let's use my IBM shares analogy. I bought 50 shares of IBM and they're worth $50 and I own them. And at the time of my death, the shares are worth $200. So they've increased $150. Well, on that type of asset, I get a step up in basis at my death. So let's say I'm 98 and I'm thinking about, I don't know, just selling my IBM shares. Maybe I need to hold on to them so that when I pass, my son inherits them at the full value and he owes no tax at all. Step up in basis. This is something you want to plan into your estate so that you leave the maximum amount to the kids or grandkids, the people you want to create a legacy for. What about on our homes? Well, the tax status on homes is much more favorable today than it was 15, 20 years ago. Used to be, if I owned a home, it appreciated in value and I sold it, I had to roll all of the gain into another home to avoid paying tax. Well, the tax rules changed in the early 2000s, and today, single people get a $250,000 step up in basis on the increase in the value of their homes. Married couples get $500,000. So how does this work? Well, let's say I bought a home for $300,000 and I'm married and now it's worth $800,000 and I sell it. How much of the gain do I pay? None. I get to keep all of the increase. I get to keep all 800 and I don't have to reinvest it in another home. So if you have a home, single people get that 250 step up, married couples get 500,000. That's a big step up. So understand this so that you understand if you're going to sell a home, what the implications are. Which begs another question. If you're, let's say, 95 and you're maybe in failing health, should you give away assets like those IBM shares or your home? The big answer, the simple answer is almost always no, don't give it away. Let's say I've got that, I've got a $300,000 home and it's appreciated to $1 million. So now I would owe some long-term capital gains. Just by holding on to the home until I die, it passes to the next generation and they pay no tax. So normally giving away assets, not a good idea. The last topic I want to touch on is property taxes. This is something, Texas is a heavy property tax state. We're the 7th highest in the nation. But the good news is when you turn 65, in all the counties in Texas, you can request a senior exemption. What does that do? I'll tell you, it does a lot. I'm 75, and it freezes the taxes, the taxable rate on your home. So I'm 65, my home is worth $500,000. I'm being taxed at that. They freeze it. And next year they appreciate or appraise the home at 600 or 700 or 800, but my tax bill doesn't go up. It's frozen. So for many of us, this tax freeze is wonderful because you've locked in the value of your home, even though it appreciates in value and in the future it may be inherited or sold. You don't pay higher property taxes all those years after age 65. Well, gosh, what if I want to move? I live in Texas, want to stay in Texas, but I want to move from home A to home B. Well, you can transfer your tax ceiling. You've locked it in at age 65, and that's a transferable benefit. So just because you're moving doesn't mean you're going to now be taxed at the value of the whole new home. You can transfer the frozen tax rate that you had when you turned 65. And this applies to widowers under age 65. If you're married and your spouse is over 65 and they've locked in the tax ceiling, only takes one of you, and then that person over 65 passes, the widower, even if they're younger than 65, locks in the tax ceiling. Pretty nice for ladies that are outliving us guys. What about age 65 property tax deferment? Well, another option, some people choose as they passed age 65 to go, hey, I'm limiting on limited income, and my property taxes, even though they're frozen at 65, are still pretty high. Well, you can do what's called a property tax deferment. And that's saying, I don't want to pay any more property tax. And the county will freeze your property, freeze it. You owe those taxes, but you don't pay them. Now, when the property is sold in the future, probably upon your death, yes, your heirs have to settle up. But let's say by deferring property taxes, I free up more income. I have more money to spend on food and in keeping my house up and on medical care. That can be a nice way to improve your quality of lifestyle in retirement. Next week, we're going to talk about ways to use your home as a strong asset to support lifestyle. And we'll share that with you next week. Other things to investigate. There are things like solar panel property tax credits. You need to check with your county to find out what tax credits are currently available. These vary by a county, but if you've got, I'm thinking about putting solar panels on my home in Burnett to reduce my monthly energy bill from Pedernales Electric. And I want to find out, do I get a tax credit, which is a reduction of my income tax just based on the fact that I'm investing in solar panels. There's a variety of other credits. Veterans, boy, there's a bunch of these out there. So just to let everybody know, it's time to make sure that you understand all of your tax opportunities when it comes to property tax. Well, gee, Tara, we covered a ton of information, very short period of time. I know next week we're going to talk about tapping home equity and using it. What do you want to share with our visitors today as we wrap this up?
Yeah, I mean, if you enjoyed our talk on Pay Less Tax, in about 48 hours, it'll be up on our website. You're welcome to listen to it again, share it with friends or family, and of course, always give us a call. So we really appreciate our time today with you, and we'll see you next week. Thanks so much.